Well, hey there. Welcome to Zak Wealth Files. I'm Zak. Let me ask you something. Ever feel like you're saving and saving, literally doing everything right, but your net worth is basically just crawling along? Like you're putting in maximum effort for almost zero visible reward? You are definitely not alone in feeling that way. And I want you to know right now, it's not a flaw in your discipline. In this explainer, we're going to look at the exact mathematical reason why building wealth suddenly accelerates after you hit one specific milestone. We're going to keep the math simple, accurate, and genuinely useful, so you walk away today knowing exactly what to expect on your financial journey.
The late Charlie Munger, Warren Buffett's longtime business partner at Berkshire Hathaway and a legendary billionaire investor in his own right, once told a room full of shareholders something incredibly blunt. He basically said, "The first $100,000 is a bitch, but you gotta do it. I don't care what you have to do. Find a way to get your hands on $100,000. After that, you can ease off the gas a little bit." And he meant that quite literally. He essentially suggested walking everywhere and skipping every single unnecessary purchase just to grind your way across that line.
Okay, so let's dive into this. $100,000. Now, it is super easy to look at that number and think it's just, a motivational round figure, just something that looks impressive on a spreadsheet. But it's actually not. What Munger was getting at is a real structural turning point. It's a place where the actual math of compound interest fundamentally shifts underneath your feet.
We need to look at the shift in who or what is doing the heavy lifting here. Below a certain asset level, your wealth grows almost entirely from what you personally contribute out of your paycheck. Think about a $5,000 portfolio. If that grows at a healthy historical average of 7% in a given year, it generates $350. Mathematically, sure, that's real growth, but practically speaking, it's genuinely almost irrelevant next to what you are actively saving from your income in that same year. But look at a $100,000 portfolio. That exact same 7% return generates $7,000 in a single year without you having to lift a finger or deposit another dime. That is money your investments generated entirely on their own. It's doing meaningful, real work right alongside your paycheck. This is the actual mechanism behind Munger's advice to ease off the gas. Your money has finally become a second, silent worker in your household.
Now, a quick reminder up front that historical averages, like that 7% we just talked about, are illustrative estimates, not guarantees. And obviously, all investing carries risk. But looking at these estimates shows us a massive difference over time. Getting from 0 to 100 grand usually takes the absolute longest. For someone starting from nothing, making reasonable, consistent monthly investments, it commonly takes a decade or more. During this entire first phase, the primary driver is your active contributions. But look at the climb from 100,000 to 1,000,000. The relative speed completely shifts to accelerating. Using the exact same monthly contribution and the same average return, your second 100,000 comes faster than your first. The third comes faster than the second. And it's not because your income or savings rate suddenly shot up, but because investment compounding is now operating on a massive base the entire time. So the crucial point you need to understand is this. Early progress is a one-to-one reflection of your savings discipline. Every single dollar is a sacrifice. Think of it like building a snowball. Before compounding really kicks in, you are out in the cold, packing that snowball entirely by hand. There is zero gravity or momentum working in your favor yet. If you stop packing, well, the snowball stops growing. That's exactly why it feels disproportionately difficult and just painfully slow. And honestly, there is no shortcut around this phase. The math simply requires you to build that base first before compounding can actually take the wheel.
$100,000 isn't some universal magic wand for every single person. The true threshold depends entirely on your own personal income and spending levels. If you have a very high income and correspondingly high expenses, 100 grand might not represent nearly as significant shift for you as it does for someone living on a much more modest income. The real underlying principle isn't the six-figure mark itself. It's reaching an asset level relative to your specific expenses where investment growth transitions from being just a minor background detail to a major heavy-lifting contributor.
And it's not just the math that changes. Reaching this milestone triggers a profound psychological shift too. You transition from hoping financial independence is theoretically possible to genuinely expecting it to happen. And it brings incredible, practical, real-world freedom. When you have a six-figure buffer, the immediate consequences of any single setback feel far less catastrophic. You literally gain the power to say no. You can say no to a toxic job. You can say no to some unnecessary expense pushed on you by social pressure. You can say no to risky financial decisions driven by desperation.
Step 1. Maximize your early savings rate. Treat this early phase as the time where your personal discipline has the absolute highest dollar-for-dollar impact it will ever have. Step 2. Prioritize consistency over market timing. Trying to pick the perfect stock or timing the market is just a distraction. Consistent long-term investing tends to heavily outperform attempts at precise timing, especially when your contributions are doing the heavy lifting. Step 3, and listen, this is your immediate action item for this week. Automate. Invest first, spend what's left. Go set up an automatic transfer the day you get paid so your progress doesn't rely on whatever cash just happens to be left over at the end of the month. Step 4, track your invested assets, not just your income. A higher salary means literally nothing if your lifestyle inflates and your invested assets stay flat. And step 5, expect the early phase to feel slow. It's supposed to. That is the actual predictable shape of the math before compounding takes over.
Now, before we wrap up the core takeaways of this explainer, I want to reiterate a few mandatory, honest disclosures. The growth figures we've discussed today are illustrative estimates based on long-term averages. Actual investment returns will vary significantly year to year, and they carry a real risk of loss. There is no guaranteed timeline for building wealth, and this explainer is strictly for general education, not personalized financial advice. Always run your major decisions by a licensed professional.
The idea that the first 100,000 is the hardest isn't just some old investor's tale. It is a literal, mechanical shift in how wealth is generated. You move from being the sole engine of your wealth to having compounding work tirelessly right alongside you. So I genuinely want to hear from you. Where are you currently in this climb, and does the "it gets easier after this" math match your own real-world experience so far? Drop a comment below. And hey, if this explainer gave you a clearer, more honest picture of long-term wealth building, make sure to subscribe to Zak Wealth Files as a credible source you can actually come back to. Keep compounding, and I'll see you in the next explainer.